The $1,000 Portfolio. How to invest your first grand in 2026. If your $1,000 is sitting in a checking account in 2026, you are silently losing purchasing power every single month. Inflation may not be 9% anymore, but at 3–4%, while the Fed holds rates at 4.5%, idle cash is financial decay. And here's the part nobody tells beginners. Your first $1,000 is the most important money you will ever invest. Not because of the amount, because of the habit, because of the asset allocation decisions you make right now, because the difference between guessing and building a strategy compounds for decades. This isn't about getting rich quick. This is about building your first real portfolio, the $1,000 portfolio for 2026. Let's build it properly. The problem and the opportunity. Here's the 2026 backdrop. Interest rates are stable around 4.5%. Not zero, not emergency stimulus. Infrastructure spending is accelerating. Power grids, data centers, energy exports, domestic manufacturing. Capital is flowing towards real-world assets, businesses and sectors tied to physical demand and real cash flow. But the average beginner investor? They're doing one of three things: keeping cash in a bank account, buying random meme stocks, throwing everything into a single broad index without understanding risk. Meanwhile, the top 1% think differently. They focus on strategic asset allocation, intentional portfolio diversification, and long-term compounding interest. They don't ask, what's the hottest stock? They ask, how do I structure risk for the next decade? That's the gap. And with $1,000, you're not limited. You're early. Let me show you how to deploy your first grand like a capital allocator, not a gambler. 2. The deep dive. 4 actionable pillars. We're going to divide this $1,000 into 4 pillars. Each serves a different purpose: growth, income, stability, asymmetry. Pillar 1. The core. Broad market ETF, 40%. Allocation, $400. First rule of investing: own the market before you try to beat the market. A low-cost, broad index ETF gives you exposure to hundreds of companies. This is instant portfolio diversification. You reduce single company risk, you participate in overall economic growth. You let capitalism work for you. Historically, broad U.S. equities have returned around 8 to 10% annually over long periods. If your $400 grows at 8% annually for 20 years, compounded, it becomes approximately $1,865. That's one piece of your original $1,000 turning into nearly double without picking a single stock. But here's the bridge. The index is powerful, but 2026 isn't a spray and pray environment. Certain sectors are outperforming because of macro shifts, which brings us to Pillar 2. Pillar 2. Energy and real assets, 25%. Allocation, $250. In 2026, infrastructure demand is surging. Energy companies are generating real free cash flow. Many are returning capital through dividends and buybacks. Why does this matter? Because in a 4.5% rate environment, cash flow matters more than hype. Adding energy exposure improves asset allocation by including a sector that benefits from physical demand and inflation resilience. Let's assume this portion earns 9% annually, including dividends. Your $250 over 15 years becomes roughly $913. And here's the hidden advantage. Dividends reinvested accelerate compounding interest, but energy is cyclical. Oil prices move, geopolitics matter, so we balance it, which leads us to stability. Pillar 3. Treasury bills and cash equivalents, 20%. Allocation, $200. Here's something beginners ignore. The fence wins championships. In 2021, cash paid nothing. In 2026, short-term treasury bills yield around 4 to 5%. That's government-backed income with minimal volatility. If your $200 compounds at 4.5% for 10 years rolled over consistently, it grows to about $310. Not explosive, but strategic. Why? Because this portion acts as dry powder. When markets drop 15 to 20%, you deploy this capital into discounted assets. This is how you create a margin of safety. Now here's the bridge. We've covered stability, we've covered broad exposure, we've covered real assets. But what about growth? Not speculative hype, calculated growth. Pillar 4. High-quality growth stocks, 15%. Allocation, $150. In 2026, unprofitable tech struggles, but companies with strong balance sheets and consistent earnings growth continue to scale. We're talking about firms with positive free cash flow, manageable debt, reasonable price-to-earnings ratios. This is targeted exposure, not YOLO investing. Let's assume this segment earns 11% annually over 15 years. That $150 becomes roughly $720. Higher risk, higher reward. but capped at 15% of your portfolio to control volatility. This is intelligent portfolio construction. How the full $1,000 works together. $400 broad market, $250 energy, $200 treasuries, $150 quality growth. Now imagine the blended return averages 8.5% annually. In 20 years, that $1,000 becomes approximately $5,100. Not by gambling, not by guessing, by disciplined allocation and reinvestment. And remember, your first $1,000 is rarely your last. Add $100 per month to this structure. At 8.5% annually, in 20 years, you're looking at over $60,000. That's how wealth starts. 3. Risk management and 2026 outlook. Now, let's be realistic. Markets are volatile. 2026 is not risk-free. What could go wrong? Black swan scenarios. A sudden global recession crushing energy demand. A geopolitical shock disrupting commodity supply. A surprise rate cut cycle inflating tech valuations and hurting treasuries. A liquidity crisis in credit markets. This is why we diversify. This is why we rebalance annually. This is why we avoid leverage with a small portfolio. Your goal is survival, because survival enables compounding, and compounding is unstoppable over time. The biggest risk isn't volatility, it's panic selling, or never starting at all. 4. Conclusion and call to action. Let's lock this in. 3 key takeaways. Asset allocation matters more than stock picking, especially with your first 1,000. In 2026, real-world assets and disciplined cash flow exposure matter. Stability and growth must coexist in the same portfolio. This is how you think like the top 1%. Not flashy, strategic. If you want to see the exact ETF examples, rebalancing schedule, and my full 2026 beginner portfolio breakdown, click the link in the description to access the 2026 Portfolio Blueprint. It shows you how to automate contributions, reinvest dividends, and track performance step by step. Now I want to know, if you had $1,000 today, would you invest it, or would you wait for the perfect time? Because the truth is, time in the market beats timing the market. And your first grand, it's either your foundation or your excuse.